everybody. Welcome to Looking at the Markets with David Modell. People often write to me and they tell me that they think that the stock market is going to crash soon or it's going to go down very soon. And I cannot guarantee that that will happen or not happen. But people often ask me how they can profit. So I'm going to tell you right now 4 different ways that you can profit if you take these actions right before a stock market crash. Now, your timing has to be pretty good with these, but if you do any of these things and the stock market crashes, you will probably not only profit, but you'll probably make a lot of money percentage-wise on your trade, all right? And they all involve risk, so don't do any of these things without doing your own research, understanding the risks, and that sort of thing, okay? Do these at your own risk, at your own peril, please, because the stock market can keep going up. You just don't know, all right? So the first thing you can do is short selling or shorting index tracking ETFs, such as SPY, which tracks the S&P 500, QQQ, which tracks the NASDAQ, and DIA, which tracks the Dow Jones. And so short selling, I'm not going to go into a long explanation, but basically instead of buying something and then selling it later, hoping that the price goes up, what you're doing is you're selling something first, hoping the price goes down, and then buying it back. And so what you're essentially doing is borrowing shares of these ETFs from your broker, selling them to somebody, hoping the price goes down so you can buy them back at a lower price than you sold them at. And then, of course, you have to return those shares that you borrowed. You have to return them to the broker. All right. Now, there are risks involved in shorting or short selling. First of all, there's no limit to how much you can lose when you short sell. Because what if you short an ETF or a stock or whatever, and then the price just keeps going up and up and up? There's no limit to how far an ETF or stock price can go up. It could just go up indefinitely, and now you're losing more and more money. You could possibly even lose more money than you have in your brokerage account, and you could end up owing the broker money that you don't even have. So please be aware of that risk. And also there's another problem involved with it, which is that since you're borrowing shares from your broker, of course they're probably not going to let you borrow something for free. They're going to charge you interest on that, and so you're paying interest. And so if it takes a long time, you could end up paying, a lot of interest or a substantial amount that could really eat into your profits or even cause a loss. So be aware of those. And so of the four methods I'm going to mention today of potentially profiting if the market goes down, this is not the one that I recommend. But I want you to be aware of it and what it is. All right. So short selling index tracking ETFs like SPY, QQQ, DIA, that kind of thing. That's one way to do it. Another method is buying inverse ETFs, inverse index tracking ETFs. All right. So just as there are ETFs like SPY, QQQ, DIA that track the progress of the stock market, there are ones that go in the opposite direction of the stock market. All right. So if the stock market goes up, these inverse ETFs are supposed to go down, and they're not perfect. All right. They do not do inverse tracking perfectly. All right. Actually, none of these ETFs track their respective indexes perfectly. There is tracking error. So don't expect them to be perfect in doing their job of tracking what they're supposed to track. All right. So if you want an ETF that is supposed to go in or attempts to go in the opposite direction of the S&P 500, there's SH. And then there's PSQ, which attempts to go the opposite direction of the NASDAQ, and there's DOG, or DOG, which attempts to go in the opposite direction of the Dow Jones. Of all the 4 methods I'm going to tell you about today, this is the one I like the most. I'm not recommending any of them necessarily, or not recommending, I'm just saying this is probably the safest one. Because with the first method, remember that one, short selling, how that has no limit to your potential losses. If the market just keeps going up and up and up, you can lose more and more, even more than you have in your account. Well, if you buy an inverse ETF, you could lose a lot of money. You could even lose 100% of your investment, but you will not lose more than that. The most you could lose is your 100% of your investment plus any commissions or fees or anything like that. And there might be tax-related issues as well. But beyond all that, you should not lose more than that. All right, so at least there's a floor to how much these can go down, and a ceiling as to how much you could possibly lose just by buying something as opposed to shorting it. All right, so that's the one I would probably recommend out of these four if you're going to do any of them. Not that I'm, again, recommending any of them. So number 3 is buying volatility or long volatility ETFs. For example, VXX, UVXY, and TVIX, TVIX. What these do is they are designed to go up if there is a big spike in volatility or fear in the stock market. All right, if suddenly there's a lot of fear, if everybody's afraid, investors are afraid, then these are designed to go up in the short term. Okay, but over the long term, they have a tendency to go down. If you look at a long-term chart of any of these, VXX, UVXY, TVIX, they have a tendency to go down over time. So please be aware of that, and be aware that like TVIX is leveraged, for example. UVXY is leveraged, VXX not leveraged, but still they are not they're not things that you want to hold for a very long time. All right, but if you believe that the stock market is going to crash or go down a lot very soon, then you can get in and out of these quickly, and at least it does not have the unlimited risk that short selling does. All right, and then the fourth method, you do need an options trading account for this, which is buying put options on SPY or QQQ or DIA. All right, and now this has a disadvantage, which is theta decay. When you buy an option, then it kind of, I guess you could say, deteriorates over time. Unless the underlying asset, unless SPY or QQQ or DIA goes down very quickly, very soon, then you might not be able to profit. Even if the underlying asset goes the direction you want it to, like down, for example, in this case, you could still lose money when buying a put option just because of the effects of theta or time decay. All right, because options have a tendency to deteriorate in value over time. It might not happen so fast in the short term, but as you get closer to the expiration date, then theta decay really starts to kick in a big way. And so even if you're right about the direction or the movement of the underlying ETF, you could still lose money potentially. However, if you bought a put option on one of these and then the stock market crashed the next day, for example, or that day, then yeah, you could make a lot of money very quickly. That is possible. I'm not saying it's probable, but that is another way using options to make money if the stock market goes down very soon. All right. So which one do I recommend? If I had to recommend any of these, probably number 2, buying inverse ETFs such as SH, PSQ, and DOG. But you got to be careful with these because, again, the stock market could just keep marching upward for longer than any of us would imagine. How many people predicted that we would now be experiencing the longest American equities bull market in stock market history here in the United States? It was easy to imagine that maybe a year ago, but who predicted that back in 2009? Not too many people, okay? So things can last longer than they really should, so I want you to be careful, all right? So if you have questions as far as wanting to put together a trading plan or how do you trade these, you really definitely want to have a plan. Otherwise, you could get in a lot of trouble financially. You can contact me for coaching. I do offer that. My email address is right here, davidmodell@gmail.com. All right, be careful out there. Know what you're doing. And hey, good luck, everybody. Thanks a lot. I'll talk to you again soon.